Good afternoon to everyone on the East Coast. Good morning to, I think we have some on the West Coast and some in the middle of the country. Again, my name's Domenic Segalla. I lead the healthcare advisory practice here at Withum, and I'm going to spend the next 15 minutes talking about the Provider Relief Fund and specifically reporting via the portal. I would assume most of you on this call have received some type of Provider Relief Fund. Anyone who received in excess of $10,000 based on the attestation that you signed, you now have to report via the HHS portal, and we'll talk about the timing of that when we get into this a little bit more.
All right, we're going to start off with our first polling question. Have you started reporting your data via the HHS portal? All right, about 10 more seconds. Reminder, in order to get CPE credit, you have to participate in all 4 polls. All right, I'm going to close it out. And here are the results.
Okay, great. And thanks, Rachel. And you know, based on that, assuming based on the time of your receipt, and we'll talk about that, you have up until September 30th. But one important thing here, and if there's one takeaway from everything I say here, please look at this slide. There's some really good information here. Has hyperlinks to the reporting user guide. It has a data entry worksheet we'll talk a little bit about, and it has a provider support hotline that I've called numerous times with clients. They're very responsive. There's not a long wait. So if you get to the point during the reporting of this and you need help, they're very readily available, excellent support. Next slide. So this is important. So back in June, HHS came out and said, we are now going to really clarify based on date of receipt of monies you received, when you have to use those funds, when you have to report on those funds. The majority of you on this call, my assumption is, received period 1. So again, it goes by date of receipt of the dollars you received. Many of you received more than one payment. Let's just assume you received a payment in April or May of 2020. You had until June 30th of this year to utilize those funds. We'll talk about that. And you have to report on it by September 30th, and we'll talk about that. There's others of you that may have received phase 3 money that came in either end of December, beginning of January. You can see what this allowed for now. It allowed an extended period of time to utilize these funds. So if you receive something in December of 2020, you have this whole calendar year to utilize. You don't report until March of 21. So it allowed for a longer period of time. The only downside to this is, for those of you who received different payments in these different periods, you have to wait for that specific period to report. So you can't get all your reporting done right now. If you receive something in December of 2020, you have to wait until that specific period of reporting time. Next slide. So what I want to do now over the next 15 minutes or so is just walk you through. We've helped numerous clients so far. We've been in the portal. I want to give you a feel for what it's going to be like, what data you need when you actually go into the HHS portal to report on the information they're requesting. Again, any of you that received greater than $10,000, you're required via your attestation to report via the portal. If you do not, there's recoupment of your payments, etc. The other thing to note here is, if you have not registered, I assume everyone on here has registered, you have to register via the portal. It takes about 15 minutes, but you can't access the portal if you haven't registered yet. And the reason I say that is because step 1, when you go into the portal, most of the information that you did in the registration process will pre-populate. And it'll talk about the type of entity you are. You'll have to answer a few basic questions, type of provider, subtype, etc., but pretty straightforward. And before we go into more detail, everything in the portal is based on quarterly reporting. You're going to have to focus on 10 quarters. The 4 in 2019, the 4 in 2020, and the first 2 quarters of 21. 2019 is always the baseline, clearly because pre-pandemic. 2020, 2021 is the use period for these funds. So step 1, again, most of it came from your registration process. Step 2, seeing most of you on the call are physician-based. This will not be as big of an issue for you. A lot of our larger academic health settings, it's based on subsidiaries. It's based on if you divested or acquired new entities. We could do a whole section just on this, but it really gets into, then you have to list the TINs and the EINs of those you divested and those you acquired, and any corresponding funds it received. So it gets a little bit more confusing, but any questions on this, if you do have any of these subsidiaries, you can reach out to me after. So step 3, this is really important. Step 3, when you're in the portal, it's actually going to show you the different dollar amounts you received and the corresponding date. So it's important to note that they have the correct information. So please make sure you say, okay, these are the 3 payments or the 2 payments I received. This is a dollar amount. This is the date. If they are incorrect, stop right there. Call the hotline that we had given you the number for on the previous page. Really important, because everything else is predicated on step 3 being accurate. Step 4 is almost 3 steps in one. The biggest piece here is interest earned. And for many of our clients, when the money was received, they utilized it right away. During the pandemic, were shut down, needed to cover costs, needed to cover payroll, etc. So there was no interest earned. For those of you that had it sitting in an interest-bearing account, come up with some reasonable estimate. Is it 1 month in an interest-bearing account? Even though we all know, very little, if any, of interest is being accrued because the rates are so low right now. They will ask you for tax information. Just, are you a C Corp, an S Corp, an LLC? And then single audit information. They're just asking if you've had to perform a single audit in the past. A little bit confusing here. And if you have not had to require a single audit or perform one, you can just fill NA to move forward with it. If you did receive greater than $750,000, reach out to your auditors, because you will be required to either have a program-specific audit or a single audit. Next slide. So step 5, some confusion here. The only reason the government is asking for this information is for them to gather the data. So any type of other assistance received. Clearly, the biggest one for most of our clients is PPP. Some have FEMA. There was some HHS CARES Act testing. So if you had uninsured patients and you actually submitted these claims to the uninsured portal and received that back, they want to understand the dollar amount. Again, has no impact or no bearing on anything else in this portal. It was the way for the government to try to assess what other dollars all that were received from a federal standpoint for all of you. Next slide. So here's really where we start to get into the meat of things. Just to go back and to reiterate, it's a 2-step process. So those of you that receive provider relief funds, there's 2 ways to utilize the funds. Step 1, expenses. 3 words to remember here. Any expense that was used to prevent, prepare for, or respond to the pandemic. So normal rent, you're going to pay that irregardless of the pandemic. But social distancing, if you acquired, you purchased new equipment, clearly from a cleansing standpoint, from a cleanliness, any expenses, gowns, etc., masks that you expensed, purchased, acquired because of the pandemic, those all qualify for expenses to be utilized for the provider relief fund. Step 2, and we'll talk about, is then whatever's left over is a lost revenue calculation. But again, for step 6, they're going to ask you, what are the expenses? that you incurred that because of the pandemic. And remember 3 words: prevent, prepare for, or respond to. If you received less than $500,000, very general. They're going to put it in 2 different categories: G&A or healthcare related. If you received greater than $500,000, you're going to have to break it out into subcategories, and they lay that out for you in the portal. Step 7 is interesting. So this is for, and I'll give you an example. If you received $100,000 in PRF funding, but you spent $200,000, so you had expenses of $200,000, they want to know, the government, what are those unreimbursed expenses attributable to coronavirus. So in that instance, you received $100,000, but you spent $200,000, you would put in $100,000. We believe they're gathering this information because there's still about $20 billion out there under the CARES Act, and we think there will be another distribution of funds. We're not sure of the methodology yet, but clearly with the uptick in the Delta variant, this will help them try to decipher how much they will actually have to reissue to cover some of these unreimbursed expenses. The next section is the lost revenue. So remember, I stated it's a 2-step process. You have your expenses, and then you have your lost revenue. Many definitions around lost revenue. We're going to focus on basically the one that most of our clients are using, and it's the actual revenue versus, so it's actual versus actual. You will see within the portal, and one of the things you're going to need to gather is patient service revenue for the 10 quarters. Remember, it's always those 10 quarters, as I stated, all of 19, all of 20, first 2 of 21. They will ask you to break it down by payer. We have helped many of our clients, and if your system does not allow to break it down by different payer categories, we've had many that have just done Medicare and grouped everything else into other, Medicare, Medicaid, grouped all commercial into other. The important point here is that you're consistent quarter over quarter. So however you break this out, it's not as important to break out of the payer as it is that your aggregate amount on a quarterly basis is the same methodology. And I should have stated before, there's no supporting documentation to be uploaded, but clearly upon audit, they will request your backup and your support, not only for your expenses, back to a voucher or back to a PO and how you paid for it, but in your actual revenue also. So the definition of lost revenue, and the one that we utilize all the time, the actual versus actual. So 2019 is your baseline. What they allow you to do then is look at every quarter in 20 and the first 2 in 21 versus that of 2019. So I'll give you, for instance, 2019, you had $500,000 of quarterly revenue. 2020 in Q1, you had $300,000 of lost revenue, of actual revenue. So you're going to take your 2020 of $300,000 in Q1, you're going to compare it to your 2019 of $500,000, and there's a $200,000 of lost revenue. The portal will report this and they'll aggregate everything for you. The important thing of the example I just gave is that $200,000, because you had a drop in revenue, those dollars can then be applied to your provider relief fund. The nice part about the portal, it aggregates that for you, and it will show in a summary for you how much you've actually aggregated from a lost revenue standpoint. The other important thing to note here is there are no offsets. So many of our clients had lost revenue in Q1, Q2, but then Q3, Q4 of 2020, their revenue was up versus 19. They do not aggregate that, and they do not offset. So it's only those quarters where you had a drop in revenue versus that in 19, which will count towards the lost revenue. Next slide. So the other methodology is budget. Not many of our physician providers and physician clients use the budget. Basically what that is, if you had a budget in place as of March 27, 2020, you could then use your budgeted revenue for all of 20, the quarters in 20 and 21, versus that of 19. Again, more of that has been utilized on our larger academic medical centers who had budgets in place. And the alternate method, or option 3, as it's called via HHS, is a hybrid. We did have a few clients that have utilized this where they've acquired physician practices during 2020. So to get apples and apples of revenue over revenue without the new acquisition, they wanted to use the alternate method. It does require a narrative. It does create more scrutiny, and even HHS says, as you see at the bottom, all recipients seeking to use an alternate methodology face an increased likelihood of an audit. But there are situations when this does make sense. Again, the objective is not to have to send any of this money back. Next slide. So these are the last three sections. So the financial summary basically takes, and what I said, it will take your total amount of provider relief funds, it'll take the amount of expenses that you submitted, and it will take the amount of lost revenue from the section we just talked about, and it will say, you know, how much unused provider relief fund is left. Hopefully it says 0, so you don't have to send any money back because you had enough expenses and lost revenue to offset this. If you are in a situation where you didn't have enough to cover it, you do have to send that money back to the federal government, and there is a portal within the first page that we gave you that will tell you exactly the steps to, or just reach out to us and we can assist with that. The last piece here, and it's somewhat of a nuisance, but they do request, again, quarterly for 10 quarters, consistent with everything else, that you have to submit personnel data, and that's going to be broken out between full-time, part-time, clinical, non-clinical, contracted, furloughed, separated, and hired. Many questions that have come about to us is what time frame do we use? Do we use end of the quarter, beginning of the quarter? As long as you're consistent, we have some that have used first day of the quarter, we have some that have used last day of the quarter. Again, consistency quarter over quarter so they can see from a metric standpoint for your FTE count. They're also going to ask for some type of metric around your facility. For you, probably visits, it could be encounters. Our hospital clients are more on the admission side. So that's the last piece of quarterly data you'll have to complete. Step 12 is a survey, just asking a lot of questions around it. Step 13, we've gone through this with many clients. As soon as you complete it, you hit submit. It will instantly say, thank you for completing this survey. Probably anywhere from a minute to 2 minutes later, it'll come back and say, here's the outcome, nothing more to do because, you had plenty of funds to offset the money you received. We have had a few instances, and we've been on the phone with them, where there have been a few glitches. Even though they had plenty of funds to cover, it basically said that they had to send money back. If that does occur, go back to the first slide or the second slide of this presentation, call the hotline, reach out to us, reach out to your advisors. We can help you walk through that. So that's just a high-level summary of what you will see when you enter the portal and what data you need to gather so that you can go into the portal and complete it. The other thing I'll just say is you can stop and save at any point in time, and you can re-enter and it pulls up all the data. So it's not something you have to do in one sitting. You can break it out over whatever time period you need. Just make sure if it is due by September 30th, based on the date of your receipt, you do have that done by then. So at this point, I'm going to turn it over to Dan Mayo, and then any questions for me, we can wait till the end. Thank you.
Great, thank you, Dominic. And so now we're going to talk about the employee retention credit, which is something that's on the minds of a lot of physicians and healthcare practices. It can lead to a tremendous amount of refund opportunities. So let's start on the next slide with polling question number 2.
Our next polling question, have you claimed the employee retention tax credit? About 20 more seconds. All right, 10 more seconds, then I'll close it out. Okay, and here are the results. like 42% voted yes.
Great, thank you for that. So let's start with talking about the employee retention credit, what it is generally, and we have a lot of links here to all the recent guidance. So it's a fully refundable tax credit for wages paid during the periods of economic hardship. And those are defined in one of two ways: either a full or partial suspension of your business operations relating to the pandemic, or two, a more than 50% decline in gross receipts in 2020, or a 20% decline in any quarter in 2021. And we'll go over more of the details in the coming slides about this. But these are sort of the two entryways to the employee retention credit. And a lot of people, we get the question a lot, what is a fully refundable tax credit? Essentially, it means free cash. And so if you're paying wages to your employees anyway, and the IRS will give you money back based on the wages that you pay to your employees. So it really is, if you're eligible, it is a check, you will get a refund check from the IRS that's based on the wages you paid to your employees during periods of these economic hardship, as we'll talk about. Came in March 27th as part of the CARES Act, but it was very restricted at that point because there was a limitation saying you cannot claim the employee retention credit if you got a PPP loan. And that restriction was removed on December 27th in that Consolidated Appropriations Act 2021. And this is really what opened the floodgates to the employee retention credit and caused thousands and tens of thousands of businesses to apply for the credit. And so now if you received a PPP loan, either one or two, you can still claim the employee retention credit for 2020 and 2021. And it's really a significant opportunity because the maximum credit is $5,000 per employee in 2020 and $7,000 per quarter in 2021. So $28,000 in 2021, $5,000, $33,000 maximum per employee. So a pretty sizable opportunity. We do have many clients receiving refunds in the millions of dollars. In one case, over $10 million. So we do have some fairly sizable credit opportunities here. The guidance that's come out from the IRS has been certainly coming with increasing frequency. On March 1st, they issued that notice 2021-20, and you see it's hyperlinked there, so you can access it just by clicking it. That is a 102-page notice that provides a lot of the details around the program. And also it largely repeated and expanded upon the FAQs that were on the IRS website. So the IRS had posted around 90 or some on number of frequently asked questions on his website. That notice formalized and updated them. Then on March 11th, Congress passed and the President signed the American Rescue Plan Act, which extended the employee retention credit to the end of 2021 to all 4 quarters. And each quarter in 21 does operate independently. You get a reset, so you can get that $7,000 per employee each quarter. The IRS followed up with 2 notices in April and August, dealing with the rules for the ERC and how they changed slightly in the first 2 quarters of 21 from the last 2 quarters of 21. 9 days ago, the IRS issued a revenue procedure creating a safe harbor for the gross receipts test and how you account for PPP loan forgiveness, and if you receive the Venue Operators Act, if you're in a theater, or the Restaurant Revitalization Fund grant. Finally, that bipartisan infrastructure bill that was passed by the Senate about a week and a half ago would eliminate the ERC for the 4th quarter of 2021. It was tucked in there, a provision. It was sort of hidden away on, page 2,400 and something of a 2,700-page bill. So there is talk of eliminating it. Right now, that as of today, you can claim the credit for the 4th quarter of 2021. But if that bill is passed, it would eliminate in its present form, it would eliminate the credit for the 4th quarter. Next slide, please. So this is an overview of the 2 different credits. Let's start on remember that on the big high level before we get into this, the 2020 credit is an annual credit. You can get 1 credit, meaning up to $5,000 per employee for the entire year, so March 13th to the end of December, whereas in 2021 is a quarterly credit where it resets every quarter. So you add up the wages and get 70% of the wages paid up to $10,000 per quarter, which is why the 2021 credit is so much more valuable than the 2020 credit. The 2 tests, you either have a full or partial suspension of operations. We'll talk about what that means, or you have a quarterly drop in gross receipts more than 50% any quarter in 2020 compared to the same quarter in 2021. And there's rules on when that continues. If you get one quarter in 2020, you automatically get to include the next quarter immediately follows it. When you go to 2021, you see the same full or partial suspension of operations test. The quarterly drop, they made it easier to claim the 2021 credit. You only need a 20% drop or more than 20% drop in any quarter. But again, the baseline is still to 2019, and this leads to a lot of confusion. So you compare Q1 21 to Q1 19, Q2 21 to Q2 19. The difference here is in the 2021 credit, you can elect to use the previous quarter. So for Q1 21, there's two ways to get it. Either have a Q1 21 versus 19 greater than 20% drop, or you elect to use Q4 of 2020. So you compare Q4 20 to Q4 19. Again, 19 is always your reference here. So there's two ways to get in there. Also, recovery startup business is not really relevant to this audience today, so we won't focus on that. The wage period we discussed, it's all of 21, and 2020 is March 13th to the end of the year. Qualified wages, it's the first 10,000 of wages, which include healthcare expenses. So for 2020, it's you take a period of your shutdown, however many quarters or periods you qualify for, add up the wages up to 10,000, and you take 50%. In each quarter of 21, you add up the wages, you stop at 10,000, and you take 70%. So it's you see how it's much more lucrative there. Even if you, so on the bottom there, that's dealing with furloughed employees. So if you had an employee that you furloughed, you did not pay cash wages, but you continued to pay their health plan expenses until you brought them back, those health plan expenses count as wages. So you can take the credit on the health plan expenses paid, even if no cash wages were paid. So that's a helpful addition to the rules. Next slide, please. By the way, I see one question came in for Domenic. We'll get to that at the end. If you do have questions, please remember to submit them to the questions link through the webinar because they do show up on a real-time basis, and we'll try to answer them real-time. If not, we have dedicated time at the end of the presentation to go over questions. So the credit amount we talked about is 50% of wages in 2020, 70% in 21, which leads to the maximums that we talked about. Advance payments, and for 2020, obviously we're past. It's just a refund opportunity at this point. There are opportunities to get a advance payment with the 2021 credit, but we won't spend too much time on that now. Next slide, please. This is one of the bigger limitations. So the key thing for large employers, and a lot of medical practices fall in this category, you're a large employer in 2020 if you had more than 100 employees in 2019. Again, the reference point is 2019. So if you were a large employer, meaning 2019, you had more than 100 employees, you can only claim the 2020 employee retention credit for wages you paid employees not to provide services. That sounds like an odd concept because it is, and most people do not pay employees for periods they're not working. But if you did, you can claim the credit. If you're a small employer in 2020, meaning your number of full-time employees in 2019 was less than or equal to 100, then you can claim all the wages paid to all employees, even if you have 600 employees in 2020. If you had below 119, you're considered a small employer for 2020, and you can claim the credit for all wages, whether the employee worked or didn't work. So it's a much more expanded credit if you're a small employer. And so you get wages you paid people to work and wages you paid people not to work. Again, and you're not capped at that 100 number of employees. So if you have 600 in 2020 because you rapidly expanded, you can claim the credit for each of those employees, regardless of whether they were employed in 2019. The credit again in 21 got even more generous. That 100 cap was raised to 500. So the large employers are people who had over 500 employees in 2019. So those people can only claim the credit for wages paid not to provide services. If you were under 500, which would probably be most, other than hospitals, be most physician practices, would have under 500 employees in 2019, then you can claim it for all wages paid to all employees. Again, even if you have 1,500 employees in 2021, test is what you had in 2019. The biggest restriction with the ERC both years is you can claim the, as we talked about earlier, as a result of that legislation in December of 2020, you can claim the ERC if you've got a PPP loan, PPP 1 or 2, but you can't double dip the wages. So you do need to back out the wages that you received, you used to justify PPP forgiveness. And you need to back that out of the ERC calculation. But the IRS doesn't provide a methodology to do that. They say any reasonable method works. So we've spent a lot of time thinking about that here at Withum, and we've come up with an algorithm which automatically sorts employees and wages and comes up with a maximum allocation to the employee retention credit. So we fill up, like for example, we fill up highly paid employees with the PPP first, so that all the wages of the lower paid employees are eligible to be used for the ERC. So that's one of many things that we do to maximize the employee retention credit. And the reason you can do that is because no methodology was required, and they said you can use any reasonable methodology. Next slide, please. So what does it mean to have a full or partial suspension? Usually it's not a full suspension. Most people deal with a partial suspension. So, excuse me, I have a cold here if you can't tell from my voice. You have a partial suspension if you have a government order that restricts your operations, the order limits commerce, travel, or group meetings, and the order affects the typical operations of the business in a non-trivial manner. So the biggest example here was elective procedures. You know, I'm based in New York and Jersey, and most of elective surgeries were prohibited from a period around mid-March to the end of May. So there was around a 70 or 75-day period that the elective procedures were prohibited. That would be considered a partial shutdown, right? Because non-elective procedures could still go forward. So that would entitle you to the credit of medical practice, to the credit for the period of that shutdown. So the effective date of the government orders, essentially. The other way to get in would be the revenue decline, but most practices had a revenue increase instead of a decline. But if you did have a revenue decline of more than 50% in any quarter in 2020 or more than 20% in 21, that is a more objective and easier way to get into the credit. But if you're in the world of a partial shutdown, you have to look at a government order that restricted your ability to provide services, either social distancing, limiting the ability of people to come in. Like if you're a walk-in clinic, for example, if you couldn't have people in the waiting room, you had to turn people away, or the elective procedure, the ban on elective procedures. So those are the kinds of things we look at to see whether a business was partially suspended. Next slide. So the aggregation rules are something that cause a lot of people headaches. You need to aggregate employers for a couple different purposes. So determining whether you have a shutdown, whether you meet the gross receipts test, your 2019 full-time employee calc, and determining the maximum credit per employee, you have to aggregate. And what they did was they referred to some pre-existing aggregation rules that say, essentially, if you have two businesses owned by the same owners, you would have to aggregate and treat them as one employer. If you had a parent subsidiary, parent owns 90% of a subsidiary, they have to aggregate, meaning you have to determine whether there's a partial shutdown by looking at both entities together. You have to look at the gross receipts test by looking at the gross receipts of both entities. Although there are some rules that allow you to disregard intercompany gross receipts, which make it a little bit easier. There's also a rule that prohibits related parties from you using the wages of related parties, where you look at a greater than 50% shareholder. So these rules they're complicated, they exist. We do spend a lot of time with employers looking at the aggregation rules when they apply, because they can get rather convoluted. But I do want to highlight they're different from the affiliation rules that many people had to consider for the PPP. And the PPP used the SBA affiliation rules. The IRS uses the IRS aggregation rules that they've written in other code sections. So they're different, and the reason I focus on they're different is in case you Google it, you will come up with different rules and get twisted around. So make sure you're looking at the affiliation for PPP and aggregation for the ERC. Next slide, please. So the taxation of the ERC is taxable. That's the sort of the short answer. The way you get there, you don't include it in gross income. So it's not like you're saying we received a credit of $2 million, we have $2 million of extra income. Well, that's not the way it works, but you will be taxed on that $2 million. And the way they do it, they say it's not gross income, but you have to disallow the wages that gave rise to the employee retention credit. So if you received a credit based on $2 million of wages, a $2 million credit, you would disallow the wages, which effectively make the employee retention credit taxable. Also, even if you get the retention credit, if you apply, let's say the 2020 credit, the expenses allowance applies in the year in which the expenses were paid, not when you apply for the ERC or when you receive the ERC check from the government. So if you apply for the 2020 ERC in January of 21 and you receive the check in July or August of 21, you still have to go back and disallow the wages on your 2020 tax return. For many people that filed on time or under extension, they do need to go back and amend their tax returns to disallow those wages. So it's kind of a pain in the neck, but that's the way the rules came out. And because they use that section 280C, we've been advising clients for months now, but they came out in the last couple of weeks, I think, and said that you do have to amend your tax returns. Next slide, please. With that, I think we'll turn it over to Dill to talk about the current tax proposals.
Thanks, Dan. Okay, so next slide, please, Rachel.
Okay, so we're on to our third polling question. How concerned are you about potential tax changes? About 15 more seconds. All right, I'm going to go ahead and close it out. And here are the results. So 55% are very concerned.
All right, that sounds about right. So we're going to take the last 10, 15 minutes of this session to give you guys a bit of an overview about what potential changes are out there, what might affect you, and we'll go from there. Now, the biggest question is when we know some sort of tax changes are coming, but we don't necessarily know when they're going to apply. And the question is it going to be retroactive to the beginning of this year? And the thing is, Congress is allowed to do that. So as annoying and as much of a pain in the neck as it is to redo some of, not necessarily redo, but you can't really plan for something you don't know when it's going to start. But Congress is allowed to retroactively enact retroactive legislation. The budget Biden is working on does assume that any increase in capital gains rates will occur as of April 28th, 2021, which means some of the things that we can hope for may not, we'll see when things come into effect, and we'll see what, next slide, please, Rachel. There's been a bunch of publications, both by the Biden administration, the Treasury, various proposals and such have been released. American Jobs Plan, American Families Plan gives you a very detailed overview of what each of these are, what their tax proposals are, what the various policy justifications are. And over the course of the last 6 months or so, Treasury's Green Book, again, these are all linked, so if you wish to read through them, you are welcome to do so. Budget. And I imagine this won't apply to many of you, but again, there's also some international changes up for potential change as well. Next slide, Rachel. I guess 2 slides down. All right. So let's talk about the individual tax proposals that might affect that will affect you as an individual. Currently, our individual tax rate caps out 37%. Possible that it will go back up to the old 39.6% rate for individuals that make over $400,000. And one of the bigger changes is this potential capital gain rate change on long-term capital gains and qualified dividend income. So currently, those items are taxed at preferential rates. So whatever your ordinary income rate is, it's likely that any long-term gains and qualified dividends are taxed at a much lower rate. But possible it can go up to as high as 39.6 tax as ordinary rates. Is it likely to go up that high? Not necessarily, but none of us have a crystal ball. It all depends. Congress needs funding. The government needs to pay for some of these proposals. So that is a potential funding trigger. So what that means for you is it might be worth triggering your capital gains if you have gains built in that you've been holding on to. 2021 might be the year to get those gains taxed because the rates aren't going to go down. They're only likely to go up. Medicare, 3.8% Medicare tax. This was introduced back in the Affordable Care Act days to fund the Affordable Care Act. And obviously the health insurance requirement has gone away, but the extra tax is still there, and it taxes you on your investment income. Now, it's still going to apply. They're going to close a couple of loopholes, so the tax base actually gets bigger because it's a good revenue source for the government, so more of your investment income is likely to be taxed. Okay, higher income taxpayers. So this proposals are going to provide more funding for the IRS to focus their audits on larger corporations, businesses, estates, and the higher income individuals. Again, anyone earning over $400,000 a year. They're looking to cover revenue gaps. Okay, they're looking to cover or tax gaps, just to say these people aren't paying as much taxes as they should, so that's what they're looking for. As far as tax cuts go, excuse me, there are some extended tax cuts for those with children and workers. You've probably already heard about expanded child tax credits. Some of those advanced funding is already coming out monthly as we go along now. Next slide, please, Rachel. All right, excess losses. That was another provision that was introduced. It applied to more people back in 2017. And currently it's set to expire in 2025, basically limits the amount of loss you can take from your business income. That limitation of losses might get permanently extended. Itemized deductions, we might return to some of that phase out. It used to be around way back in the early 2000s, I believe, and now it's going to come back possibly for those, again, earning over $400,000. So there are limits on itemized deductions, tax benefit itemized deductions. So there's a lot of play there. Social Security tax. Currently, the wage base is capped at $137,700. Index for inflation, it goes up a little every year. Looking to expand that. And okay, and their ideal situation is that no person making less than $400,000 will see a tax increase. So we'll see where that goes. Next slide, please, Rachel. Okay, SALT deduction, the 10K SALT deduction. So that's the $10,000 cap on your state and local taxes for itemized. I'm going to go into that a little bit more in a couple of slides. So they potentially repeal it. In all likelihood, it's more likely to just be expanded. It won't be a $10,000 limitation, or it might not be a $10,000 limitation. It'll go up to maybe $20,000, $30,000. I'm going to dig into that a little bit more in about 2 or 3 slides. And the qualified business income might be subject to a phase out. That was, again, came in 2017, although most doctors' offices, physicians are service businesses, so some of that might not apply to a lot of you anyway. But if it did, then you may have the items phased out. Next slide, please, Rich. Okay, corporate tax proposals. I'm not going to dive too deep into this, but corporate tax rate got dropped to 21% from 35 before, might go up to 28, somewhere in between. We don't know, but that's going to be that was a permanent cut down to 21. They might permanently bring it back up to some number in between. Okay, a couple of other items here. I don't want to dive too much into it just because there's only so much that's relevant to physician practices. But if you do have something international related, just understand the IRS is going to be cracking down. They're going to remove, Congress is likely to remove some deductions. They're coming after international corporations. Again, that may not apply to a lot of this audience, but it is there. It's part of their compliance project. Next slide, Rachel. Yeah, and we'll skip this too. Again, a lot of it's related to large multinational corporations. Okay, let's go down to a couple more slides. We'll hit estate and gift tax. We'll cover that next. I think that's, there we go. Proposed changes to estate and gift tax rules. So currently, the estate and gift tax exemption is a lifetime amount of 11.7 million with a federal tax rate of 40%. Various states have different rules of their own. When you inherit property, it gets stepped up to fair market value, and if it gets a gift, then you get the donee's basis. You don't have to know what all that means, but if nothing changes, that 11.7 million is set to go down to $5 million after December 31st of 2025. That's the way the law is written right now. Next slide, please, Rachel. Various different proposals out there, primarily in a bill introduced by Senator Sanders. Biggest thing we're looking at, a big reduction of the estate tax exemption, possibly down to 3.5 million, excuse me. State tax rates might go up, and the exclusions, they're looking to tax that big chunk of appreciation. Next slide, please, Rachel. Step-up basis, keep the step-up basis, but a limitation on various gifting and tax saving strategies. Congress is looking for revenue, and gift in the state tax world is a big place to find it. Next slide. Okay, different bill. We don't need to go into the specifics of it, but just again, various exemption rules. They might, They might tax the transfers differently. Instead of being part of an exemption, they may subject it to capital gains tax. So it's entirely possible there are some massive changes coming to estate and gift tax rules. Next slide, please, Rachel. From President Biden himself, no mention of real changes to the exemption. Gifts would be subject, or transfers at death subject to a capital gains tax rate, and some other small exemption rules. So talk to your estate planners, talk to your accountants, figure out, now would be a time to make sure your estate plan is set in a place where it could go, in a place to be advantageous. Next slide, please, Rachel. Okay, again, just some more technical details related to estate tax. I don't want to bog us down too much, but let's go down to the next slide. One more. Okay. Small state update. One of the biggest things we're seeing now, and as I said, we're going to dive into that state tax limitation a little bit more. Back in 2017, state tax deductions for itemized deductions was capped at $10,000. Those in higher income tax states essentially lose out on 5, 10, dozens of thousands of dollars of deduction, and many states, especially those in higher tax areas, have been putting together workarounds, the SALT caps, primarily through the enactment of what are known as pass-through entity taxes. So next slide, please, Rachel. Generally, pass-through entities aren't taxed at the state, aren't taxed by themselves. The owner individually gets the taxable income. Instead, what the states are doing is enacting a tax that the business itself pays, and then the owner gets a credit for that tax on their state tax return. As of July, more and more states, if we were to go back 6, 7 months from July, there would be a lot less green on this map. You could be in a state that has one of these new pass-through entity taxes. Next slide, we're going to go just through some numbers just to show you how it works and how it can be advantageous for you. All right, so suppose you have $1 million of income, both federally and for the state. So you got $1 million of taxable income, and you've got a 10% state tax rate and a 25% federal rate. Okay, $250,000 of tax goes to the federal government, $100,000 goes to the state. If you don't elect into this PTE tax regime, you're going to pay $100,000 state taxes. That amount will be subject to your itemized deductions. If you itemize at all, that is capped at $10,000. So you immediately have up to $90,000 of state taxes that just disappear. You can't deduct them anywhere. And if you itemize, if you don't, then your entire $100,000 is not deducted on your federal tax return. So you can pay up to $250,000 of federal taxes plus the $100,000 of the state taxes. So that's $350,000 total. If you elect in, and again, these are just rough numbers, super simple example, that now the business will pay potentially the $100,000 of state taxes, meaning for federal purposes, you only have $900,000 of income. That $100,000 gets added back, so you're still taxed at $1 million in your state, but federally you're only paying tax on $900,000. $900,000 times the 25% is $225,000, and again the $100,000 to the state. You've saved $25,000 of tax. New Jersey enacted one last year for the year 2020. New York is enacting it. It just came out a few weeks ago. So, or more details just came out a few weeks ago for New York. And as we said on the map, a whole lot of states have enacted it in the last few months, enacted a similar system in the last few months. So again, talk to your accountants, talk to your advisors, understand if this is right for you. Next slide, please, Rachel. Okay. Last one. This is New Jersey specific. In June, Governor Murphy signed the New Jersey College Affordability Act. Now, there's 4 new provisions looking to assist people saving for college or paying off tuition or paying for college in general. I've listed out the provisions here. If you start a new NJ Best account, so a Section 529 plan in New Jersey via their NJ Best system, if your gross income is $75,000 or less, your initial deposit will be matched by the state up to $750. Every year you contribute to an NJ Best account, and your gross income is $200,000 or less, you can get up to a $10,000 deduction from your New Jersey return for that contribution to the 529 plan. If you have certain student loans and you're paying them down, and again, they are either principal or interest, you can get a $2,500 deduction and up to $10,000 for tuition payments made to New Jersey state colleges or universities. So again, if you've got a college student or you're paying off loans, this might apply to you and you live in New Jersey. Rachel, next slide.
Okay, we're on to our 4th and final polling question. Do you have a college student? All right, 20 more seconds, and then we will go to the questions that came in. All right, I'll go ahead and close it out. And here are the results.
All right, thanks, Rachel. Dan, did we have any questions come in? I think you said one came in for.
Yeah, we got a bunch of questions came in. Most of them are from Domenic, or for Domenic. One is for me. I'll take that one first. For employee retention credit of 2020, they say that they had 50 partners in their S Corp. They need to refile K1s. for 2020? The answer is yes, they do need to amend. If they filed already and did not include the employee retention credit, they will need to amend the return and issue new K-1s. I know it's a major hassle, but that's what they contemplate doing. Dom, do you want to cover the rest for you?
Yeah, if you could just read them out, that'd be great.
Sure. One is with the PRF reporting, is there a way to see all the questions and information needed ahead of entering the portal?
Basically, that's what I tried to give you without going into the portal. If you follow the different sections that we gave you, it's almost verbatim as the information you're going to need. It's actually, the portal's a little bit more simplified, to be honest.
Okay, next question is the portal user guide says that the amount of funds entered from other sources will not be used by the portal in calculation of expenses or lost revenue. But then it says that the reporting entity has to make its own determination of expenses after considering other assistance. So is this done manually before entering eligible expenses or revenue?
Yeah, this is a great question. It's confusing. So none of that information gathered applies to what's in the portal. The point they're trying to get at, and I should have mentioned this, you cannot double count or double dip the expenses. So, you know, if you're using expenses for FEMA, you can't use that same expense for PRF or provider relief funds. Same thing with PPP. The difference, majority of expenses for PPP is payroll, utilities, mortgage, rent, etc. Those are not common expenses within the provider relief fund, but just make sure if you did receive other assistance, you're not double counting any of those expenses. It has to stand on its own for provider relief funds.
Okay, last question. I know we got 1 more minute left, so this will be the final one, obviously. Provider relief, will only patient revenue included or other income included in the reporting? Thanks.
So another good question. So do not include PPP or any other assistance. This is strictly patient revenue. If you're cash basis or accrual basis, just make sure you're consistent for every quarter so you're showing that information, but just patient revenue.
Great. Well, everybody, thank you for joining. We appreciate your attendance and the questions, and feel free to reach out if you do have additional questions. Thanks again.
Thanks, everybody. Take care.
Thank you.